If you looked at the silver market this morning and felt that something did not make sense, trust that feeling because it is there for a reason and you are not overreacting. You're not being dramatic, and you're definitely not imagining patterns that do not exist in reality. What you are seeing right now could be the early steps of one of the biggest shifts in the precious metals market in modern history. This is not some wild internet rumor, and it is not a late-night conspiracy theory designed to scare people. The numbers we are about to talk about are public, easy to verify, and posted for anyone willing to check. The real question is why so few major news networks are talking about them in a serious way. At this moment, the COMEX exchange, which plays a major role in setting global precious metals prices, is holding between 103 and 120 million ounces of registered silver in its vaults. Registered silver means metal that is actually available to be delivered to buyers who demand it. It is supposed to be the physical backing behind the massive amount of paper contracts traded every single day. Now here is where things start to get uncomfortable for anyone paying attention. The total open interest in silver futures contracts currently stands at 429 million ounces. That means traders have claims on 429 million ounces of silver that they expect could be delivered. Think about that for a second and let it really sink in. There are promises for 429 million ounces, but only a little over 100 million ounces sitting there ready to go. That works out to more than 4 paper claims for every single ounce of real silver in the vault. In simple terms, for every 1 ounce of physical silver, there are 4 different promises attached to it. If everyone suddenly decided they wanted the real metal instead of a cash payout, the math would not work. And when math does not work in financial markets, things can change very quickly. Before we go deeper into this, I want to hear from you. Drop a comment and tell me where you are watching from today. Whether you are in the United States, the UK, Australia, India, or anywhere else, I want to know what you are seeing in your local market. Here at Alex Carter Reports, we are building a community that shares real information from the ground level. Are your local coin shops running low on silver products? Have you noticed premiums climbing higher than usual when you try to buy physical silver? Your experience matters because local conditions often show stress long before national headlines catch up. When regular people start noticing tight supply and rising premiums, that is often an early warning sign. And those warning signs are flashing right now in many places. Let's talk about what happened in January 2026, because this is where things get serious. In that single month alone, 40 million ounces of silver were requested for physical delivery. That number is far from normal by historical standards. In a typical month, you might see somewhere between 5 and 10 million ounces stand for delivery. Jumping to 40 million ounces represents about a 400% increase from what is considered average. That kind of spike does not happen by accident. It suggests that large players are choosing real metal over paper settlements. They are not satisfied with cash payouts that close out contracts quietly behind the scenes. They want the actual silver moved into vaults they control. When that behavior becomes widespread, the entire pricing system starts to feel pressure. The paper market depends on the idea that most people will settle in cash instead of demanding metal. If too many participants ask for delivery at the same time, the system gets stressed very quickly. Now step back and look at the bigger picture. Silver finished 2025 up more than 130% for the year. It began that year at $29 per ounce and ended above $70. Moves like that do not happen every year, and they rarely happen without a deeper reason. Now, in early 2026, silver is already trading above $82 per ounce. That tells you the trend has not cooled off. It has continued to build strength. While this is happening, many financial commentators are still calling it simple volatility. They suggest that investors should stay calm and focus on traditional stock portfolios. But the price action in precious metals is telling a different story. When silver and gold rise during uncertain economic conditions, it usually signals concern beneath the surface. Investors tend to move toward hard assets when confidence in paper systems begins to weaken, and that shift appears to be gaining momentum. Let's connect this to the broader economy. Recent data showed that U.S. retail sales were flat in December. Consumers pulled back on major purchases, including motor vehicles and other big-ticket items. When consumer spending slows, it often reflects financial stress building quietly in households. In response to that data, the 10-year Treasury yield dropped to nearly a 1-month low. Falling yields often support higher precious metals prices because metals do not pay interest. As yields moved lower, gold climbed above $5,050 per ounce. Silver jumped more than 2% in a single session. Markets were clearly reacting to the idea that the economic outlook may not be as stable as officials suggest. The Federal Reserve has maintained that conditions remain stable and cautiously optimistic. However, investors are now pricing in at least 2 25 basis point rate cuts in 2026, with the first expected in June. That difference between what officials say and what markets expect creates tension. If rate cuts begin, lower interest rates often boost non-yielding assets like gold and silver. Historically, metals perform strongly during periods of easing monetary policy, and many traders believe we may be heading in that direction again. There is also a historical example worth remembering. In 1979 and 1980, silver surged from under $6 per ounce to $50 in less than a year. That spike was tied to tight supply conditions and aggressive buying. Today's environment is different in many ways, but the idea of supply stress remains relevant. The gap between paper promises and physical metal appears wide once again, and more investors are beginning to ask serious questions about how secure the system really is. Major institutions are not ignoring this. JP Morgan has projected an average silver price of $81 per ounce for 2026. An average of $81 suggests that prices could move significantly higher at times during the year. When a major bank releases a forecast like that, it is worth paying attention. Large financial firms typically position themselves before public forecasts are widely discussed. Retail investors often hear about these moves after much of the early positioning has already taken place. Skeptics argue that exchanges have rules to prevent a true default scenario. They point out that contracts can be settled in cash if necessary. Technically, that is correct under exchange guidelines. But even if contracts are settled in cash, confidence can still be shaken. If too many investors want metal and receive only cash, trust in the pricing system may weaken. When trust declines, markets can adjust in dramatic ways. Physical premiums at coin shops already show signs of strain. In many cases, buyers are paying far above the official spot price for silver eagles and other popular products. That difference highlights a growing gap between paper prices and real-world supply conditions. Industrial demand adds another important layer to this story. Silver is not only an investment metal, it is used in solar panels, electric vehicles, electronics, and defense systems. Unlike gold, much of the silver used in products is consumed and not easily recovered. Mining supply cannot instantly increase to match rising demand. Many silver mines operate as byproducts of copper or zinc production. Bringing new mining capacity online takes years, not weeks. When supply grows slowly but demand grows quickly, pressure builds. Over time, that pressure often shows up in higher prices. Markets adjust to restore balance when shortages appear. The gold to silver ratio also deserves attention. Historically, the ratio has averaged around 60 to 1. During major monetary stress, it has fallen as low as 15 to 1. With gold around $5,050 and silver near $80, the ratio is close to 61 to 1. If that ratio compresses while gold holds steady, silver would need to rise significantly. That mathematical relationship gives silver strong upside potential in certain scenarios. All of these pieces together create a unique setup. Rising delivery demands, limited vault inventory, strong industrial use, and shifting monetary policy expectations are converging at the same time. That combination does not appear often. Here at Alex Carter Reports, our goal is simple. We focus on the data, the trends, and the real-world signals that others might overlook. We encourage you to verify the numbers and think critically about what they mean. The silver story is not about panic. It is about preparation and understanding how markets function under stress. When paper promises grow much faster than physical supply, risks increase. Whether you already own precious metals or are still researching, staying informed matters. The information is public, the data is available, and the trends are unfolding in real time. The only question is how each investor chooses to respond. This conversation is just getting started. There are deeper forces at work behind the scenes that we still need to explore. When we step back and look at the bigger financial system, silver is not moving in isolation, and that is something many people fail to understand at first glance. Every major move in precious metals is connected to currency strength, government debt, interest rates, and global confidence in financial leadership. Right now, all of those pieces are shifting at the same time, and that combination creates powerful momentum. The United States is currently running a deficit of more than $2 trillion per year, and that number is not small by any historical measure. The national debt is approaching $40 trillion, and interest payments alone are becoming one of the largest expenses in the federal budget. When a government spends more than it collects year after year, it must either borrow more or create more currency to fill the gap. Both of those options carry consequences that eventually reach everyday citizens. Borrowing more increases long-term debt pressure and forces higher interest payments in the future. Creating more currency reduces the purchasing power of every dollar already in circulation. This is not political, and it is not dramatic language meant to scare anyone. It is basic math that applies to every country in history that has expanded debt beyond sustainable levels. When the supply of money grows faster than real economic output, the value of that money slowly declines. The US dollar has already lost over 95% of its purchasing power since the Federal Reserve was created in 1913. That decline did not happen overnight, and most people did not notice it year by year. But over long periods, the erosion becomes obvious when you compare prices across decades. Precious metals often respond to that long-term currency pressure. Gold and silver cannot be printed by a central bank, and their supply increases much more slowly than paper currency. That limited supply is one reason they have held value across thousands of years of human history. Now add another layer to this situation. Foreign governments and central banks have been buying gold at record levels, exceeding 1,000 metric tons per year in both 2023 and 2024. When central banks increase gold reserves, it often signals concern about currency stability and geopolitical risk. Silver may not receive the same headlines as gold in central bank reports, but it benefits from similar monetary trends. Investors who lose confidence in fiat systems frequently diversify into both metals. And because the silver market is much smaller than the gold market, capital flows can move prices faster. Another factor that cannot be ignored is industrial consumption. Silver is critical in solar panel production because it conducts electricity efficiently and reliably. As renewable energy projects expand, the need for silver paste in solar cells continues to grow. Electric vehicles also rely on silver in battery systems and electronic components. Modern cars contain far more electronics than vehicles built decades ago. Every additional sensor, chip, and advanced feature increases demand for conductive metals. Telecommunications infrastructure, including 5G networks, depends on silver's conductive properties as well. Defense systems, missiles, and advanced aerospace technologies use silver in ways that are not easily replaced. This metal is not decorative in those applications. It is essential. Unlike gold, which is often stored and rarely consumed, silver is used and dispersed. Once silver is embedded in electronics or industrial components, it becomes expensive to recover. Large amounts end up in landfills or products that are never recycled efficiently. That ongoing consumption means above-ground stockpiles shrink over time. If mining production does not keep pace, deficits widen, and deficits eventually influence price. Mining companies cannot simply double silver output overnight when prices rise. Most silver is produced as a byproduct of copper, lead, or zinc mining operations. That means supply decisions are influenced by other metals, not just silver prices alone. Opening a new mine requires exploration, permits, financing, and construction that can take many years. During that time, demand may continue climbing without immediate supply relief. This imbalance creates pressure that builds quietly until it becomes visible in market pricing. Now consider what happened on January 30th when Kevin Warsh was nominated as the next Federal Reserve Chair. Silver dropped 27% in a single day, and gold fell 10%. Mainstream commentators quickly declared that the precious metals rally was over, but within days, prices rebounded strongly. The rapid recovery suggested that the sell-off was driven more by short-term emotion than long-term fundamentals. Large institutional investors often use sharp pullbacks as buying opportunities rather than exit signals. That pattern has repeated many times in financial history. Short-term headlines shake confidence temporarily. Long-term structural trends continue underneath the noise. The broader issue is that the Federal Reserve appears trapped between two difficult choices. If inflation remains elevated, keeping rates high strains consumers and businesses. If the economy weakens, cutting rates risks reigniting inflation pressures. Investors currently expect at least two 25 basis point rate cuts in 2026, with the first projected for June. If those cuts materialize, lower rates typically support higher precious metals prices. Non-yielding assets become more attractive when bond returns decline. At the same time, confidence in traditional safe assets has begun to show cracks. Foreign holders of U.S. Treasury debt have reduced some positions in recent years. Even small shifts in global demand for treasuries can affect interest rates and currency strength. If global investors diversify away from dollar-based assets, gold and silver often benefit. Precious metals have no counterparty risk tied to government balance sheets. That independence becomes valuable during uncertain periods. Now let's talk about confidence, because markets run on trust as much as they run on numbers. If participants believe that paper contracts are fully backed and easily deliverable, they feel comfortable trading them. If doubts begin to spread about delivery capacity, confidence can erode quickly. COMEX rules allow for cash settlement if physical delivery becomes difficult. Technically, that prevents a formal default, but cash settlement does not solve the perception problem if investors wanted metal and receive currency instead. If that scenario unfolds at scale, paper pricing may lose credibility. Spot prices on screens might not reflect what physical buyers actually pay. Premiums could widen dramatically as real metal becomes harder to source. We already see signs of that disconnect in retail markets. Silver Eagles and popular bullion products often trade far above official spot prices. Those elevated premiums reflect real-world supply and demand rather than paper contracts. The gold-to-silver ratio remains another important metric to watch closely. Historically, when financial stress intensifies, silver tends to outperform gold and the ratio compresses. If that pattern repeats, silver could experience outsized gains relative to gold. For example, with gold at $5,050 and silver at $82, the ratio is around 61 to 1. If gold remains stable and the ratio falls to 30 to 1, silver would approach $168 per ounce. If the ratio falls further to 15 to 1 during extreme monetary stress, silver could exceed $330. These are not predictions carved in stone, but they show the mathematical leverage built into silver's position. Because the market is smaller, capital inflows move it more dramatically. That volatility cuts both ways, but during strong bull phases, it accelerates gains. Here at Alex Carter Reports, the focus is not hype or fear. It is understanding how these variables connect and influence each other over time. When debt grows, rates fluctuate, industrial demand rises, and delivery stress increases simultaneously, markets respond. No one can predict the exact day or week when a major repricing event might occur. However, we can observe conditions that historically precede large moves. Many of those conditions appear present today. The most important takeaway is preparation rather than panic. Diversification into hard assets is about balance, not extremes. Holding some physical metal can act as insurance against monetary instability. If nothing dramatic happens, metals remain a long-term store of value. If stress intensifies, they may provide protection when paper assets struggle. That dual role is why precious metals have endured across centuries of economic change. As this story continues to develop, staying informed becomes essential. Market narratives shift quickly, and headlines often lag behind real structural changes. Data, delivery reports, and supply trends tell a deeper story than short news clips. Now, let's move into the part of this story that most people do not see until it is already too late. And that is how institutional positioning quietly shapes the outcome long before headlines catch up. Large financial institutions rarely wait for confirmation from television analysts before they act, because by the time something is officially confirmed, the opportunity is often gone. They study the same public data you and I can access, but they move earlier, faster, and with far more capital behind them. When JP Morgan projects an average silver price of $81 per ounce for 2026, that is not a random guess thrown into the media cycle for entertainment. An average of $81 implies that at certain points during the year, prices could move well above that level before settling back. Institutions do not release projections without already considering how to position around those expectations. That is how the cycle often works in financial markets. Smart money accumulates during uncertainty while the broader public remains distracted or skeptical. Then, when confidence builds and retail investors finally rush in, institutions begin trimming positions into strength. The silver market is especially sensitive to this dynamic because it is much smaller than equities or bonds. It does not take trillions of dollars to move silver prices significantly. A relatively modest shift in global capital can create sharp, fast rallies. Now imagine what happens if physical delivery demands continue rising at the pace we saw in January 2026. 40 million ounces requested in a single month already stretched the system compared to normal activity. If February and March show similar numbers, vault inventories could fall toward uncomfortable levels. When inventory drops, while open interest remains high, tension builds. Traders begin asking whether delivery will remain smooth and predictable. Even rumors of tightness can change behavior almost instantly. Markets do not wait for official declarations of crisis. They react to perception and probability long before any formal statement is made. If enough participants believe physical supply is tightening, they may rush to secure metal early. That behavior alone can accelerate shortages. It becomes a feedback loop where rising demand creates further demand. Confidence shifts from everything is fine to I need to act now. Exchange rules technically allow contracts to be settled in cash rather than physical metal. From a legal standpoint, that avoids a traditional default. But from a psychological standpoint, it could have enormous consequences. If investors demand silver and receive cash instead, many will question whether the paper price truly represents physical reality. Trust in the pricing mechanism becomes fragile. Once trust weakens, volatility increases dramatically. We have seen similar patterns in other asset classes throughout history. When leveraged systems rely on the assumption that not everyone will demand delivery at the same time, stability depends on calm participation. If too many participants change behavior simultaneously, the structure shakes. Silver's leverage in the paper market compared to physical supply is significant. With 429 million ounces in open interest and roughly 103 to 120 million ounces registered, the ratio tells its own story. That imbalance works smoothly only as long as delivery demands remain contained. If demand continues expanding, the exchange may implement emergency measures. Position limits could be adjusted, settlement rules could shift to reduce delivery strain. While those steps maintain technical order, they may not maintain confidence. Investors may interpret such moves as signals that supply stress is real. That perception alone could trigger further buying in physical markets. Retail investors often enter late because they wait for official confirmation from mainstream outlets. By the time major networks openly discuss delivery strain, price levels may already be far higher. Early positioning is rarely celebrated on television. It is usually questioned. At Alex Carter reports, the goal is not to encourage reckless behavior. It is to recognize patterns while they are forming rather than after they have fully developed. Understanding the structure of the silver market helps explain why moves can become explosive. Another factor to consider is volatility itself. Silver is historically more volatile than gold, and that cuts both ways. Sharp pullbacks, like the 27% drop on January 30th, can shake out weak hands. That sudden drop happened after Kevin Warsh was nominated as the next Federal Reserve Chair. Gold fell 10% the same day, and commentators quickly labeled the rally finished. Yet within days, both metals rebounded strongly. That rebound demonstrated that underlying demand remained intact. The structural drivers did not disappear because of a leadership change. Debt levels, industrial consumption, and monetary expectations remained unchanged. Volatility often tests conviction. Investors who react emotionally to every sharp move risk selling low and buying back higher. Those who focus on fundamentals tend to view pullbacks as opportunities rather than threats. Now let's revisit industrial demand because its influence extends beyond simple consumption numbers. As artificial intelligence infrastructure expands, data centers require reliable electrical systems. Silver's conductivity makes it valuable in high-performance computing environments. Defense spending also continues to grow in many regions around the world. Advanced military systems rely on precision electronics. Silver plays a role in many of those components. Solar installations are expanding globally as countries push renewable energy targets. Each solar panel requires silver paste to function efficiently. Large-scale renewable projects therefore translate directly into silver demand. Even if manufacturers explore alternatives or reduce silver content over time, those transitions require research, testing, and new production lines. Such adjustments do not happen overnight. In the near term, current designs continue driving consumption. Mining supply remains constrained by the nature of silver production. Because it is often a byproduct metal, output depends on broader mining economics. If copper or zinc production slows, silver supply may slow as well. This tight supply-demand picture becomes more important when monetary factors align. Lower interest rate expectations for 2026 increase the appeal of non-yielding assets. At the same time, high government deficits weaken long-term currency confidence. When multiple supportive factors align, markets sometimes move in ways that surprise even seasoned analysts. Price discovery can shift quickly as participants reassess risk and opportunity. The silver market has shown throughout history that it can move far and fast under pressure. The gold-to-silver ratio remains a powerful indicator to monitor during such shifts. With gold at $5,050 and silver near $82, the ratio hovers around historical averages. If financial stress intensifies and that ratio compresses, silver's percentage gains could outpace gold significantly. For example, if gold holds steady and the ratio falls to 30 to 1, silver would approach $168 per ounce. If gold rises to $6,000 while the ratio compresses to 500 to 1, silver would trade near $200. If extreme crisis conditions push the ratio toward 15 to 1, levels above $330 become mathematically possible. Those numbers illustrate potential, not guarantees, but they show how powerful ratio shifts can be in leveraged markets. Silver's smaller size amplifies capital inflows during momentum phases. Now consider investor psychology. When prices begin accelerating, media coverage increases. As coverage grows, more retail investors feel urgency to participate. That late-stage rush can drive parabolic moves. However, those who enter only after mainstream confirmation often face higher risk. Understanding early structural signals helps avoid chasing momentum blindly. At this stage, we are watching structural signals closely. Delivery data, inventory levels, industrial demand, and monetary policy expectations are aligning in a way that deserves attention. Ignoring these signals entirely may carry more risk than acknowledging them. Diversification remains a rational approach. No one is suggesting putting every dollar into a single asset class, but having some exposure to hard assets can act as a stabilizer during uncertain periods. Preparation is about balance and awareness. It is about understanding how leverage and supply interact in real markets. It is about recognizing that paper systems rely heavily on confidence. If confidence holds, the system functions smoothly. If confidence wavers, adjustments can be sudden and sharp. That is the reality of leveraged financial structures. As we continue this discussion, the final piece of the puzzle involves timing and broader global shifts. Currency confidence, geopolitical changes, and cross-border capital flows all influence precious metals. Now let's zoom out even further and connect all of this to the global stage. Because silver is not just reacting to US data or COMEX vault numbers, it is responding to a much larger shift in how countries view money, debt, trade, and long-term financial stability. When global trust in financial systems begins to shift, Precious metals often move first and move fast. Around the world, alliances are changing and economic power is being rebalanced in real time. Several nations have been exploring trade agreements that reduce dependence on the US dollar. Even small moves in that direction send a message about confidence in the existing system. When countries diversify away from dollar-based trade, demand for alternative stores of value naturally increases. Gold has been the primary beneficiary of that trend so far, but silver, because of its dual role as both money and industrial metal, sits in a unique position. At the same time, geopolitical tensions remain elevated in multiple regions. Defense budgets are rising, and governments are investing heavily in strategic industries. Silver plays a quiet but critical role in many of those advanced technologies. Now combine that with domestic fiscal pressure in the United States, with deficits above $2 trillion annually and debt nearing $40 trillion, long-term sustainability becomes harder to ignore. Interest payments alone consume a massive portion of federal revenue. As those interest costs grow, policymakers face difficult choices. They can raise taxes, cut spending, borrow more, or rely on monetary expansion. None of those options are politically easy or economically painless. Historically, when governments carry high debt loads, they tend to prefer lower interest rates. Lower rates reduce borrowing costs and ease pressure on budgets. But lower rates also tend to weaken currency strength over time. Investors understand this balancing act. They know the Federal Reserve must weigh inflation against recession risk. And markets are already pricing in at least 2 25 basis point cuts in 2026, with the first expected in June. If those cuts arrive, precious metals could respond quickly. Gold already sits above $5,050 per ounce. Silver, trading above $82 per ounce, remains highly sensitive to policy shifts. Now, imagine a scenario where delivery stress at COMEX continues to build while rate cuts begin. Physical demand rises, vault inventories decline, and monetary easing supports investment flows. That combination would amplify upward pressure dramatically. In that type of environment, price adjustments do not happen slowly. Markets often reprice in large gaps rather than steady increments. What looks stable one week can look very different the next. Confidence is the foundation of paper markets. As long as participants believe contracts are secure and easily deliverable, pricing remains orderly. But if enough investors question that assumption, behavior changes quickly. Even without a technical default, a loss of confidence can be enough to reshape pricing mechanisms. If too many contracts are settled in cash instead of physical metal, some investors may demand higher premiums for real delivery. That premium expansion can spill into retail markets immediately. We already see hints of this when buyers pay far above spot for physical silver products. The gap between screen prices and dealer prices tells a story of its own. That gap reflects real supply and real demand, not just trading volume. Another layer to consider is how fast information now spreads. In past decades, market shifts could unfold quietly before the public noticed. Today, social media and independent financial platforms accelerate awareness. At Alex Carter Reports, we focus on translating complex data into clear understanding so you can make informed decisions. This is not about hype or fear-driven headlines. It is about recognizing patterns early and preparing thoughtfully. If silver's paper-to-physical imbalance tightens further, institutional investors may accelerate their moves. Large funds often position quietly before volatility spikes. Retail investors usually react after price moves confirm the trend. That timing difference is crucial. Entering early during structural buildup carries less emotional pressure than chasing momentum later. Patience and preparation often outperform panic and reaction. Let's revisit the gold to silver ratio one more time because it frames long-term potential clearly. At roughly 61-1, the ratio sits near its historical average. During major monetary stress, that ratio has compressed dramatically. If gold remains at $5,050 and the ratio moves to 30-1, silver approaches $168. If gold rises to $6,000 and the ratio compresses to 30-1, silver touches $200. If extreme conditions push the ratio toward 15-1, levels above $330 become mathematically realistic. These figures are not promises. They're illustrations of how leverage in small markets can amplify capital flows. Silver's relatively small market size means it reacts sharply when demand surges. Now consider investor psychology during rapid rallies. As prices climb, headlines grow louder and more confident. What once sounded extreme begins to feel normal. That psychological shift often marks late stages of strong moves. The key is distinguishing between early structural change and late-stage excitement. Right now, we are still in the structural buildup phase rather than full public mania. Delivery demands increased sharply in January 2026, with 40 million ounces requested. Vault inventories remain between 103 and 120 million ounces registered. Open interest stands at 429 million ounces. Those numbers matter because they reveal leverage within the system. If delivery demands continue climbing at elevated levels, available supply tightens quickly. Tight supply, combined with monetary easing, creates powerful alignment. But remember, diversification is about balance, not extremes. No responsible strategy involves putting everything into one asset class. Instead, thoughtful allocation spreads risk across different environments. Precious metals serve as insurance against currency weakness and financial stress. They are not designed to replace every other investment. They exist to provide stability when paper systems feel unstable. The broader financial architecture built after World War II is undergoing gradual change. Trade relationships, reserve currency dynamics, and debt structures are evolving. Silver sits quietly at the center of both industrial growth and monetary hedging. As more investors recognize this dual role, demand patterns may shift faster than supply can respond. When that imbalance widens, price adjustments become the natural release valve. Markets ultimately move to restore equilibrium. The important thing is staying informed without becoming emotional. Verify data, watch delivery trends, monitor policy decisions, and observe physical premiums. These indicators tell a more complete story than headlines alone. Here at Alex Carter Reports, we are building a community focused on clarity and preparation. We analyze numbers openly and encourage you to double-check every claim. Financial literacy is the strongest defense against uncertainty. The silver market is sending signals that deserve serious attention. Delivery activity, industrial growth, and fiscal strain are converging in one place. When multiple forces align, change often accelerates. The opportunity is not about predicting a single day or exact price target. It is about understanding direction and positioning thoughtfully ahead of large shifts. History shows that those who prepare early often feel less pressure later. As we move forward into the rest of 2026, watch June carefully if rate cuts begin as expected. Observe how physical delivery trends evolve month by month. Track the gold to silver ratio and retail premiums closely. Every one of those indicators contributes to the bigger picture. Silver is not moving randomly. It is responding to structural stress and long-term monetary realities. The window for calm preparation is always smaller than it appears. Once momentum accelerates, decisions feel rushed. Preparation before urgency is always the stronger position. Thank you for being part of the Alex Carter Reports community. Stay informed, stay balanced, and keep watching the data rather than the noise. The next chapter in this financial shift may unfold faster than many expect.